Tech stocks roared back into the spotlight today, giving Wall Street a jolt of optimism. We've seen the Nasdaq climb 1%, mainly powered by Alphabet's nearly 10% surge on the day after a federal judge has allowed Google to keep its Google Chrome browser and its partnership with Apple. That ruling sparred Alphabet from its harsh antitrust penalties it was possibly facing, and what we've seen is investors responded with a ton of enthusiasm around that. Then at the same time, the broader market told a more complicated story. We've seen the S&P 500 gain about 0.5%, while the Dow slipped only fractionally, mainly held back by tumbling energy shares. We've seen oil prices drop more than 2% on reports that OPEC and its allies may raise output yet again when they meet just this weekend. So on the surface, it looked like another tech wins the day moment, but underneath, concerns about debt, inflation, and tariffs continue to reshape the trajectory of markets. Add in the coming jobs reports, the Fed's Beige Book, and internal debates inside of the central bank, and you've got a recipe for September volatility all brewing up. Get ready for it. Let's break it all down. So the Nasdaq's leadership came almost entirely from tech. We've seen Alphabet jumped 9.1% after sidestepping penalties that could have reshaped the business model. That relief rippled across the other mega tech stocks like Apple, Dell. There was a lot of enthusiasm, like we said, but not everyone was convinced the rally can keep relying on these giants. We got analysts are increasingly pointing to valuation concerns. Companies like Nvidia, Microsoft, Palantir are all names that have carried the market since April's lows, but they're now priced at historically expensive levels. Now, here's the tension. We got Q3 earnings are forecast to grow about 8.5% year over year. Then for 2025, full year growth is expected around this 10.5% figure. Early projections for 2026 earnings suggest 13.4% growth, making 3 straight years of double-digit increases. How long can they keep going? So yeah, that's pretty impressive on paper, but to sustain those gains, the rally will need to broaden beyond the usual suspects that we've been eyeing. The Russell 2000, which is the small cap index, rose 7% in August alone, which outperformed all 3 major indexes. It's a reminder that real strength depends on breadth, not just a handful of tech giants, and that is where everybody's turning their noses for attention purposes. Now, while tech celebrated, the bond market sent a warning. So the 30-year Treasury yield briefly topped 5% today, nearing highs not seen since 2007, which is seen as a flashing signal for 2 main reasons. The first being debt sustainability. Investors are growing uneasy about the U.S. government's ballooning debt load. Higher borrowing needs mean more treasuries hitting the market, which puts upward pressures on these treasury yields, to entice investors to lend the government money essentially. Then the yield curve steepening is the second reason. The gap between short and long dated bonds is continuing to widen, and normally a steepening yield curve reflects optimism about growth, but this time, and they say the most dangerous words in investing is this time is different, but this time it's being fueled by concerns about the Federal Reserve independence and the legal fight over tariffs. So remember, tariffs have been one of the main ways the Trump administration has argued it could generate revenue for the government. The government has to keep the lights on. It has to pay all the individuals associated with it. It has to fund all of the infrastructure spending. But with courts now questioning the tariffs' legality, the prospect of those tariffs being overturned would leave a bigger gap in the government's financing picture. That could mean even more reliance on issuing these treasuries we were just talking about. And that's exactly the kind of pressure that pushes these longer term yields even higher. And what that means is higher borrowing costs for businesses, consumers, and the government alike. Now, the latest JOLTS report showed 7.2 million job openings in July, which is down from 7.4 million in June. That is the second lowest level we've seen since the pandemic. Now, this is what's really stood out. Layoffs held steady at 1.1% of the workforce. That's about 1.8 million people laid off in July alone, essentially unchanged from a year ago. So cool. Hiring also held steady with about 5.3 million Americans hired. That's a 3.3% hiring rate, which is slightly above June. The quit rate held at a 2%, suggesting workers aren't feeling necessarily confident enough to job hop aggressively and quit because they don't know that they could get another job to replace the current income or get better income than they're currently getting at their job now. So in short, the labor market is cooling gradually. Openings are down, but layoffs aren't necessarily surging. That's consistent with what the Fed officials have been saying, which a softer market, but not yet a collapse. Just a slow hiring, slow firing kind of market like we've been saying. Now, we had the Fed's Beige Book today, and give me a second and I will pull that up for us. Boom. Now, the Fed's Beige Book, it's an anecdotal survey of businesses across the 12 districts of the Fed. It paints a picture of the economy, and what it's painting is an economy under stress right now. So consumers are stretched as wages fail to keep up with the pace of prices. Businesses across retail and hospitality reported pullbacks in spending, often resorting to discounting their products, but the discounts, it's like, and I was just talking to somebody about this, it's like they raise their costs and then just discount it. So it's like the prices they've always been, but it's with the discount. So it's cool. We could spend the money. But auto companies saw more customers opting for repairs instead of new purchases. So there's really this toll taking on consumers, making them more unwilling to spend money. Then on the labor front, companies aren't rushing to expand payrolls. Some are even allowing headcounts to shrink naturally as these employees continue to leave. Goes back to that quits rate, which is pretty low. But tariffs are adding to input costs, is what this Fed's Beige Book has revealed. But many firms are saying that they're struggling to pass those increases on to consumers, which is a squeeze on margins. And when margins are squeezed, earnings don't look as good. So let's look at some of the parts that I highlighted out of this. So across districts, contacts reported flat to declining consumer spending because for many households, wages were failing to keep up with the rising prices. The labor markets, I thought this one was interesting. 7 districts noted that firms were hesitant to hire workers because of weaker demand or uncertainty. In 2 districts, they reported an increase in layoffs, and in multiple districts reported reducing headcounts through attrition. I think that's the word. Encouraged at times by return to office policies and facilitated at times by greater automation, including new AI tools. So is AI taking our jobs? Most districts mentioned an increase in the number of people looking for jobs. However, half of the districts noted that contacts reported a reduction in the availability of immigrant labor. And I just made a side note. Immigrant labor is often seen as cheaper labor. So that means if these companies do have to replace their immigrant labor that's no longer available, they have to pay these American wages, which oftentimes are much higher than what they'd pay these immigrants. I'm not saying that's right or wrong, but that's just often the case here. And when the costs are higher for these companies to operate, to fill inventory, to make these goods or perform these services, when those costs are higher, either the business makes less money or the people have to pay more for those goods or services. So that's just kind of what I noted from the Beige Book. So it's a snapshot of an economy holding together, but fragile. So we'll keep on watching that for now. But Back to the internet, because I was on Adobe. Let's talk about the Fed, because we had some Fed speakers today. So Fed policy, Fed officials are showing that they're split, but their opinions are shifting. So Fed policy makers are circling around the question of whether or not to cut rates at their September 17th interest rate decision meeting. And we're seeing a split between the Fed members, and it's always really been that case. So Alberto Musalem, who is the St. Louis Fed president, struck more of a cautious tone today. He acknowledged the downside risks of the labor market, but also emphasized inflation pressures, and especially from those tariffs. He hinted that he's open to a cut, but isn't fully convinced that it's a necessity just yet. Also, Raphael Bostic, he's the Atlanta Fed president. He's watching the labor market carefully, but he doesn't seem to think that the market is collapsing, at least yet. He sees one cut this year, but hasn't committed to the timing of that cut. And for him, inflation is the larger concern, that these tariffs are going to show up in the data, and it may show to be sticky, or at least show up in the data a little bit longer than a lot of people are thinking, because a lot of people think that this will just be a one-off. Hey, there's the tariffs showing up. They're not going to continue to influence the data. So for him, inflation is the bigger concern unless Friday's jobs report comes in very weak. Remember, mark your calendar for Friday, because that is the day the jobs report will be coming out. Now, there's a third Fed speaker today, the Fed Governor Christopher Waller, and what he has been is the loudest advocate for cutting rates at the Fed. He wants not just one, but he wants a cut this month, but more so a series over the next 3 to 6 months. And his logic around this is that when the labor market turns, it turns fast. And the Fed shouldn't wait until it's too late, rather than, all right, let's jump ahead of the curve, and then we could decide, all right, should we cut rates? Should we not cut rates? We can go from there, but hey, let's at least start reacting now, because we're all kind of forecasting this economic slowdown later on this year. And why would we wait around to react to it rather than be the force that it's reacting to in a case? So this split highlights Powell's challenge. He wants to build consensus while the Fed is under political fire and dealing with the uncertainty around the economy. And tariffs are headed to the Supreme Court. So that's just adding another layer of uncertainty. And the Trump administration confirmed on Tuesday that they will ask the Supreme Court to overturn the appellate ruling for, I feel like that's the word, right? That appeal, that the ruling was found that most of those tariffs were illegal, mainly around the reciprocal tariffs. But the court said that the Trump overstepped his authority under that 1977 International Emergency Economic Powers Act. So while tariffs will remain in place until about mid-October, around that that October 14th date, the ruling casts doubt on one of the administration's core revenue streams, and that could completely change everything as far as what Trump's whole tax and spending bill was built off of. His whole administration campaign was built on these tariffs, bringing money into the U.S. So if they go away, yeah, there's other ways to bring in tariff revenue. You could do the sectoral tariffs and pull your strings and levers here and there, but it won't be the same as these reciprocal tariffs. And the debating in these deals, it just won't hold the same leverage. Treasury Secretary Scott Bessent is preparing a legal defense, warning that losing tariff revenue could mean a devastation for the entire country. And what the White House argues is that these tariffs bring in hundreds of billions of dollars in revenue and help reduce these government deficits, this national growing deficit that's been this elephant in the room that everybody wants to tackle, but it's hard. It's easier said than done. So without them, the pressure is to issue more debt and thus raise Treasury yields, which only grows the deficit, only grows these yields, and only grows borrowing costs, making it even tougher out there in the economy. So where does all of this leave us? Tech stocks are carrying the markets, but valuations are, what they're referring to, is stretched, and sustainability depends on where these earnings go. Do they continue broadening out or not? Treasury yields are climbing, driven by debt concerns and uncertainty over tariffs and what happens with those. Then the labor market is seen to soften, and some of the data is showing that, but it's not collapsing just yet. JOLTS data, we got jobs data, that jobs report coming out Friday, and wage trends are all critical to watch out for. The Beige Book shows consumers are stretched and businesses are squeezed, and Fed officials are remaining divided, with some pushing for cuts and then others are holding back, or at least like, hey, I don't want to cut rates. All under the shadow of political pressure, with Trump wanting them to cut rates. Tariffs are on a collision course, with the Supreme Court raising big fiscal and market questions, because do they stick around or do they not? Manufacturing is still contracting even as orders and jobs show small improvements. So in other words, September has started with volatility. The catalysts ahead are the jobs, inflation, and Fed decisions, and that tariff fight that might take a lot longer to settle out. Not even just the deals, the Supreme Court decision on what they're going to do. So this could be one of the most consequential months of the year for markets. As we track the stories, the key theme is uncertainty, and it's not going to get more certain. I'm imagining it's just going to keep on getting more and more uncertain. That is the key word of this year, everybody. Tech may still deliver gains, but the broader economy is flashing both resilience and fragility. The next few weeks, and especially this Friday, that jobs report in the Fed September meeting will go a long way in telling us whether this rally still has room to run or if caution will dominate the fall. Everybody, I hope your night's great. Thanks for sticking around with me. Watch out for the next video and have a blast.